A car door slams shut on Hester Street, Lower Manhattan, summer rain beading on yellow paint. A driver slides behind the wheel at 4 in the morning, starts the meter, owes $900 before his first fare. The medallion bolted to his hood is not a license. It is a mortgage, a trap, and someone else holds the deed. If you love stories about systems built on debt, power that moves through paperwork instead of bullets, and empires that collapse not with raids but bankruptcies, make sure to follow, because this one ends with an entire industry drowning under loans it can never repay. New York City, spring 1963. The medallion system is 26 years old. 13,863 yellow cabs roll through 5 boroughs, each one carrying a small metal plate stamped with a number. That plate costs $11,000 to buy outright. Most drivers cannot afford it. They lease from fleet owners who run garages in Long Island City, Woodside, East New York. The owners set the terms. Pay your weekly lease or lose your hack license. Miss a shift, you are out. Damage the cab, you cover it. The math never works in the driver's favor. By Friday night, after fuel and fees and the garage cut, a cabbie working 60 hours walks away with $70. But the medallion itself is gold. Whoever holds the physical plate controls access to the street. No medallion, no legal taxi work in the 5 boroughs. That scarcity becomes currency. By the late 60s, organized crime families operating through Teamsters locals and independent operators begin to see the angle. It is not just about owning cabs. It is about owning the loans that let drivers think they can own cabs. The Lucchese family controls trucking and air freight out of Kennedy Airport. The Gambinos run the Fulton Fish Market and construction unions. Both families recognize passenger transport as another choke point. If you can control dispatch, garage access, and medallion financing, you control the labor pool without ever picking up a fare. Certain fleet owners in Queens begin taking guidance from men who never show up on Department of Motor Vehicles paperwork. Loan terms get longer. Interest rates climb. Drivers sign documents they do not fully understand in languages they barely read because the broker tells them it is the only way in. Dispatch fees emerge as another lever. In Chicago during the 1970s, radio dispatch companies dominate. A driver without a dispatcher sits idle. Checkers Taxi Association and Flash Cab operate the largest networks. Both maintain relationships with local Teamsters officials, who are themselves linked to the Chicago outfit. Joseph Glimko, a labor racketeer convicted in 1954, ran taxicab operations through Teamster locals before his death in 1968. After Glimko, control fragments, but the structure stays intact. Dispatch fees rise from $5 a week to $20, then $40. Drivers who complain find their calls routed to someone else. Union grievances go nowhere because the union representatives work both sides. The real profit is in the medallion loans. New York, summer 1987. Medallion prices have climbed to $55,000. A Pakistani immigrant named Rashid buys one through a broker on Roosevelt Avenue. The broker is friendly, speaks Urdu, explains the American dream in terms Rashid understands. Work hard, own the medallion, own your future. The paperwork is in English. Rashid signs. The loan is for $65,000 at 12% interest over 10 years. Rashid does not know the medallion only costs $55,000. The broker pockets the difference. The lender, a small finance company with offices in Forest Hills, does not ask questions because the broker brings them 12 deals a month. Rashid drives 16-hour days, 6 days a week. After the loan payment, lease fees for the cab itself, insurance, fuel, and garage charges, he clears $200 a week. He cannot save. He cannot get ahead. After 3 years, he owes more than he borrowed. The broker offers to refinance. Rashid signs again. This is not a scheme. It is a system. By the early 1990s, the medallion loan business is professionalized. Companies like Medallion Financial Corporation emerge, offering loans specifically for taxi plates. Lenders work with brokers who work with fleet owners, who work with drivers who speak little English. and understand even less about compound interest. Everyone takes a cut. The driver holds the risk. Insurance fraud threads through the whole operation. Staged accidents are common. A cab rear-ends another car at low speed on the Grand Central Parkway at 2 in the morning. Both drivers exchange information. 3 days later, the other driver files a claim for whiplash, lost wages, psychological trauma. A doctor in Elmhurst, connected to a personal injury lawyer in Jamaica, writes up the injuries. The insurance company pays out $15,000. The lawyer keeps $5,000. The doctor gets $3,000. The staged driver gets $2,000. The rest vanishes into accounts held by people who never touched a steering wheel. These accidents happen in clusters. Certain intersections in Brooklyn, certain on-ramps in Queens see patterns. The NYPD knows, the insurance companies know, but proving coordination requires surveillance, wiretaps, cooperation between agencies that do not share information. The scams continue because the payouts are smaller than the cost of investigation. A single case might net $20,000. Prosecuting it costs $50,000, so the companies write it off. The fraud becomes overhead. Chicago, fall 1993. Federal investigators begin looking at labor racketeering in the taxi industry as part of a broader RICO investigation into outfit control of Teamsters locals. Wiretaps pick up conversations between dispatch company managers and union representatives discussing which drivers get prime airport shifts, who gets suspended for minor infractions, how to handle drivers who complain to the city. The taped calls reveal a simple system. Drivers pay a monthly fee off the books for protection. The fee is $100. In exchange, their dispatch calls get priority. They avoid random vehicle inspections, and union grievances get processed. Drivers who do not pay wait longer for fares, get written up for minor violations, lose their airport permits. The protection racket is old, older than taxis, older than prohibition. What makes it work in passenger transport is the regulatory structure. Drivers need so many permits, so many inspections, so many sign-offs, that adding friction is easy. A Medallion owner who does not play along suddenly fails emissions testing. A fleet garage loses its license renewal over a paperwork error that can be fixed with a phone call that never comes. The leverage is bureaucratic. The threat is not violence, it is waiting, delays, complications that cost time and money until compliance becomes cheaper than resistance. But the loan operations produce the most damage. New York, spring 2004. Medallion prices break $200,000. A broker named Gene Freidman controls more than 900 medallions, earning him the nickname Taxi King. Freidman operates through shell companies, leasing medallions to immigrant drivers under terms that guarantee they will never pay off the debt. His loans are structured with balloon payments, adjustable rates, penalties for early repayment. He charges drivers fees for insurance that he arranges through companies he partly owns. He charges fees for bookkeeping, for medallion maintenance, for administrative overhead. By the time a driver makes his loan payment, he has paid Freidman 3 times over. Freidman does not hide. He drives a yellow Hummer, wears expensive suits, brags to reporters about his empire. In 2014, he tells a journalist he provides opportunity. He is helping people, he says. Without him, these immigrants would never own anything. But the loans are fraudulent from the start. A New York Times investigation in 2019 reveals that brokers routinely inflated medallion prices, working with lenders to finance purchases far above market value. A medallion selling for $400,000 would be financed at $700,000. The broker and lender split the excess. The driver, believing he bought at market rate, signed documents he did not read and could not afford. Michael Cohen, personal attorney to a real estate developer in Manhattan, operates a side business in taxi medallions. Cohen owns 30 medallions, financed through loans from banks that later report suspicious loan applications. In 2018, Cohen pleads guilty to tax fraud and campaign finance violations. Buried in the plea are admissions that he lied on loan applications for his taxi businesses, claiming income that did not exist to secure $22 million in financing. Cohen cooperated with federal investigators, but served 3 years. Gene Freidman, facing 4 counts of criminal tax fraud, cuts a deal in 2018. He pleads guilty to 1 count, agrees to pay a $1 million fine, and cooperates with investigators. He serves no prison time. The 900 medallions he controlled are sold off, auctioned, transferred. The drivers who leased from him are left holding loans on medallions that are now worthless. Because by 2014 the entire system is collapsing. Uber launches in New York in 2011, Lyft follows in 2014. Ride-sharing apps do not require medallions. Drivers sign up with a smartphone. No garage fees, no dispatch charges, no broker taking 10%. Within 3 years, medallion values drop by half. By 2017, they are below $100,000. Drivers who borrowed $700,000 in 2014 now owe more than their medallion is worth by a factor of 7. Suicides follow. In 2018, 5 New York taxi drivers kill themselves within a 6-month span. 3 leave notes mentioning debt. The city responds with hearings, reforms, promises. The Taxi and Limousine Commission launches an investigation into broker misconduct. The investigation finds widespread fraud, brokers lying about income requirements, lenders approving loans for borrowers who earned $30,000 a year on paper but were being asked to repay $2 million over 15 years. The math never worked. It was never supposed to work. The system was built to extract, not to sustain. New York Attorney General Letitia James files a claim in February 2020, accusing the city of fraud, alleging the Taxi and Limousine Commission artificially inflated medallion values to generate auction revenue, knowingly pushing drivers into unsustainable debt. The claim seeks $810 million. The city denies wrongdoing. As of 2025, the case is unresolved. The racketeering was never about controlling a single garage or shaking down one driver. It was structural. Organized crime figures understood that labor markets built on debt are more profitable than labor markets built on violence. You do not need enforcers if the contract does the enforcing. You do not need threats if the threat is embedded in the payment schedule. Chicago saw similar collapses in the 2000s. Dispatch companies consolidated under private equity ownership. Drivers were converted to independent contractors, losing union protections they never effectively had. Garage fees increased. Lease terms shortened. Drivers who once worked for one fleet found themselves rotating between 3, none offering health insurance, all demanding cash deposits. The outfit, weakened by decades of RICO prosecutions, no longer controlled the racket directly. They did not need to. The structure they built in the 70s and 80s had been absorbed into legal business practices. The protection racket became the business model. Progressive Credit Union, based in New York, was one of the largest lenders to taxi medallion buyers. Between 2006 and 2014, the credit union issued hundreds of millions of dollars in loans, financing deals that brokers brought in at inflated prices. When the market collapsed, Progressive was left holding loans that would never be repaid. In 2019, the credit union sold its taxi loan portfolio to Penn Fed Credit Union at a steep loss. Drivers who borrowed from Progressive found their loans sold multiple times, each sale adding fees, changing terms, making it impossible to track who they owed or how much. Medallion Financial Corporation, the lender that built an empire on taxi debt, faced SEC charges in December 2021. The commission accused company president Andrew Merstein of fraud, alleging he paid for articles promoting the company's stock while hiding the company's deteriorating loan portfolio. Merstein and the company settled in 2025, paying fines but admitting no wrongdoing. The stock, which traded at $12 in 2014, dropped to under $2 by 2020. Investors lost millions, drivers lost more. What remains is debt. Thousands of drivers in New York still owe money on medallions worth a fraction of the loans. Refinancing programs offer partial forgiveness, reducing debt to $200,000 for medallions now valued at $80,000. Drivers take the deal because the alternative is bankruptcy, which means losing the medallion and still owing the balance. They drive for Uber now, leasing the same cars they once owned, paying the same dispatch fees under a different name. The commuters who took those cabs in the 80s and 90s, who paid $3 for a ride from Midtown to Brooklyn, never saw the system. They saw a cab, a driver, a fare. They did not see the loan officer in Forest Hills, the broker on Roosevelt Avenue, the fleet owner in Long Island City, the insurance adjuster in Elmhurst, all taking pieces. They did not see the union rep who never returned calls, the dispatcher who routed fares to drivers who paid extra, the city official who approved auction prices that brokers told him to approve. Labor racketeering in passenger transport succeeded because it hid inside paperwork. There were no beatings, no bombings, no headlines about mob hits outside taxi garages. The violence was financial, the weapon was debt, and the system, built over decades, became so embedded in the industry that when it finally collapsed, no one could separate the crime from the business. A medallion bolted to a hood in 2025 is not worth the metal it is stamped on, but the loans are still real, the debt is still owed, and somewhere, in an office far from Hester Street, someone is still collecting.